Hello, I'm JP Powers, Chief Investment Officer at RWA Wealth Partners. Thanks for joining me for this month's market update. There are many storylines impacting markets today, but for now, the one that leads them all is that of the Federal Reserve. Earnings, geopolitics, and themes like artificial intelligence all matter, but right now, Fed policy is still the dominant force shaping market sentiment, expectations, and valuations. Let's start with a quick snapshot. After a continuation of last month's move, the S&P 500 is now up roughly 12% year-to-date through mid-September, keeping that index near record territory despite some angst earlier this month over a weak jobs report. And as you've probably seen in the headlines, despite this market strength, the Fed just cut rates for the first time since December, moving their target range down to 4 to 4.25%, and forecasting 2 more cuts of 25 basis points each by year-end. While these Fed announcements have become must-see TV, the 25 basis point cut was widely anticipated by market participants. And even the 2 additional moves have been reflected in the 2-year Treasury now for some time. The market's actually anticipating even more cuts next year, with that 2-year yield down to roughly 3.5%, as shown on this chart. That's not all that different from a year ago when the Fed started cutting rates initially before taking a pause, but it's a sharp change from the near zero yields on these bonds just a few years ago, and a reminder of how dramatically the interest rate environment has shifted since then. But what matters now is the path forward. The Fed is clearly signaling concern about the labor market, even as inflation remains above target. Let's take a closer look at that labor market, which has clearly cooled off. The unemployment rate has ticked up to around 4.3%, and job growth has slowed meaningfully. After a reasonable start to the year, we're now averaging only about 26,000 new jobs per month over the last 4 months. It's not quite recessionary, but it's a far cry from the hot jobs market we saw over the last several years during that post-COVID recovery. Companies just appear to be more cautious on hiring right now, and are probably waiting until they have more clarity on the economic outlook. On the other end of the Fed's dual mandate, inflation is still a concern. Both consumer and producer prices shown here are running in the mid to high 2% range overall. That's not excessive, but remains above the Fed's 2% target. Breaking things down further, you can see core goods, which excludes food and energy, had been flat or negative, but are now picking up. That's almost certainly due to tariffs, which have been largely walked back but are still at their highest levels in several generations. And for their part, services inflation remains sticky, still running in the high 3s, even though they've steadied there for much of this year. Now, this split between goods and services is important. The Fed was getting the disinflation it wanted in some areas, but not all. Without tariffs, it's possible they might have cut rates sooner. Instead, policy adjustments may have been delayed while they waited to see those trade policies play out. Even now, the impact remains uncertain, and that's why the central bank is stressing caution, with Fed Chair Powell even acknowledging at his press conference that there is no risk-free path to avoid stagflation. That's not a word we want to hear out of the Fed very often. But with these ongoing rate cuts, it's clear they want to support the labor market at the potential risk of letting inflation flare up again. It's also a unique moment at the Fed. They're under pressure to lower rates even as equity markets are making all-time highs and inflation is running above target. Typically, when markets are doing well and inflation is high, you'd expect the opposite. But they're clearly concerned about some downside to the economy here. And of course, politics are part of the conversation as well. As a reminder, Chair Powell's term ends in the spring. While he has now set the stage for several rate cuts to come, if markets or the economy start to stumble, he's likely to face further public scrutiny on his way out the door. It's a story to watch closely in the coming months. Now, let's shift to one of the biggest ongoing investment stories of the cycle, artificial intelligence. AI is becoming more accessible in everyday tools, and the use cases are growing rapidly. The market is rewarding any company that hints of exposure to AI these days, particularly in the mega cap space. We saw that with Oracle's large move this month after they secured a $300 billion order for their cloud services from OpenAI, even though it won't start until 2027. This initially sent Oracle's stock up over 40% as it put them in the mix with other providers, Microsoft, Amazon, and Google. And then a follow-on announcement from NVIDIA that they were investing $5 billion in Intel sent that stock up over 30% overnight. That was good news for Intel shareholders who've been waiting for some signs of life from that company. And the Oracle news was certainly good for Larry Ellison, but the sheer size of these moves highlights some of the frothiness in this market. As we've seen in the past with almost any great technological breakthrough, and AI is that, the market can get ahead of itself over the short term. And as much as we want these stock gains to continue, at times like this, we need to be sure we are adjusting our expectations. The build-out of AI has required tremendous resources and will continue to do so. The past 18 months have seen extraordinary capital spending from the Big Four, Microsoft, Amazon, Meta, and Google. Microsoft has been investing at a pace of nearly $30 billion a quarter. Amazon has guided to more than $100 billion in CapEx this year, much of it tied to AI and Amazon Web Services. Alphabet recently raised its spending outlook to roughly $85 billion, and Meta is planning around $70 billion for 2025. That's a dramatic shift. CapEx as a percent of revenue has climbed materially, and we're showing here how it's expected to go even higher in 2026. This spending is required to keep pace with demand for AI. The challenge is that revenues may not arrive to offset this spending for several years, if ever, for some companies. Monetization of AI services is still largely out of reach. And just as with the internet era, the broader ecosystem might benefit before those companies funding the build-out do. Think back to the 90s and early to mid-2000s. Those telecom and equipment manufacturers had to build out the infrastructure before companies like Google and Facebook eventually unlocked massive profitability. But it took years. In the meantime, the internet lifted all boats. Hardware, software, infrastructure, they all benefited from adoption, even if monetization lagged at that platform level. But many of those early providers aren't even around anymore, or were swallowed up by a more successful follow-on company. The difference now may be that today's AI leaders know those playbooks. They've studied advertising, subscription, and cloud monetization models. That may shorten the runway to profitability, but the risk is still there. Capital outlays are massive, valuations are high, and if revenues disappoint or are just delayed, all of these stocks that are now trading in tandem on the way up could be vulnerable on the other end. You only have to go back a few years to see how quickly these stocks can reverse course. Remember how steep the sell-off was in 2022 before this run began? Meta on its own sold off more than 75%, and Microsoft was off almost 40%. Those are catastrophic numbers you wouldn't expect to see unless a company was at risk of going out of business. But when valuations get stretched, a reversal in sentiment can take the rug out from beneath them in a hurry. Now, we certainly aren't betting against the impact of AI. To the contrary, we see it as one of the underpinnings of long-term economic strength for global markets. But there is a cost to building out those capabilities that these companies are paying now. And it remains to be seen who will be best positioned to benefit from those efforts in the years to come. So, what should investors take away from all this? First, let's stay disciplined. It's easy to look at the landscape today and expect the positive momentum in stocks to continue. The Fed has shifted into easing mode, which should support markets, but they aren't cutting rates just because the White House wants them to. There are real risks coming through in the economic data, particularly on the labor front, which are forcing the Fed's hand. Second, be selective. AI is a secular growth theme with staying power, but the scale of CapEx raises the bar for returns. That argues for measured exposure. We want to own the innovation, but we need to size these positions appropriately to reflect both the opportunity and risk on a go-forward basis. And third, remember that markets are forward-looking. Bond yields often move before the Fed takes action, and equities aim to price in themes before revenues materialize. Let's be forward-looking on your plans as well. With markets making all-time highs, this may be the right time to harvest gains for upcoming distributions, gifts, or cash needs. Set those aside now while you're in a position of strength. That's it for this month's update. Thanks for watching, and as always, please reach out to your RWA advisor with any thoughts or concerns about how to navigate through this environment. We'll see you for the next update soon.